Hello, welcome to Accounting 2010 Chapter 4 videos. Video 1, Preparing the Financial Statements. We're going to be returning to our Roadrunner's Roost problem to finalize Chapter 4 and the accounting cycle. We've been following Roadrunner's Roost through Chapter 2, where we analyzed journal entries or transactions and recorded them in the general journal, the Dear Diary. Then we showed the process to post them to the general ledger, the summarizing of the general journal. Then we prepared the unadjusted trial balance. In Chapter 3, we looked at adjusting entries. How do we go around at the end of the month and look at what kind of adjustments we need to make to the accounts to properly match our expenses to our revenues? And then we prepared the adjusted trial balance based off of those adjustments. So let's go ahead and jump back out to the Roadrunner's Roost documentation, the spreadsheet, the workbooks. And in Roadrunner's Roost, just very quickly, we went through our entire month and we did all of the journal entries. Dear Diary, here's what's happened. We analyzed whether they were debits or credits. Did the accounts go up or down? We also had made the adjustments. We had everything posted in the ledger, and we had several accounts. We had grouped the assets together, the liabilities. We have our equity accounts. We have down below our expense accounts. We had stated in Chapter 3 that we had with our assets the contra assets account. They were joined to show how much depreciation we were accumulating and attach it to our assets. This will show up in the balance sheet as a carrying value or current book value, so we can give full information about our assets. So we left Chapter 3 with the adjusted trial balance. And we had noted that the difference between the unadjusted trial balance and the adjusted trial balance were the additions of accounts such as accumulated depreciation on the computer and furniture. And note, when I say it's a contra asset, assets have a normal debit balance. The contra accounts have a normal credit balance, opposite of the asset, to show it is a reduction to the value of the asset. We recorded all the expenses, and in order to do so, we had made some adjustments. We had reduced the asset prepaid and increased the expense insurance. The same with rent. So as we added those expenses, we created the adjusted trial balance. The final step before we close out our books is to prepare the financial statements. And it is from the adjusted trial balance that you will prepare the financial statements. And as you already know, the first financial statement we prepare in the Is She BS is the income statement. So what to note here is that we want to make sure that we have a nicely formatted income statement. We have the name of the company. We have that, what type of a financial statement are we looking at? And we also want to record the period of time. And this is an important feature that you will now begin to understand why it says for the month ended. And we will talk about that. Our financial statements are prepared at a certain date. It could be at the end of the month, at the end of a quarter, at the end of a year. So we want to detail when were they prepared. In the case of the income statement, it is only for the month of July. And we are going to be closing out these accounts as one of the last steps in our accounting process, our accounting cycle. We're going to close them out because revenues are only the revenues we made in July. Expenses are only the expenses we spent in July. And this net income is only reflective of July. And so we're going to have to be bringing these accounts to zero so we can start all over again. And I will show you that in the next video. So as you know, the income statement is revenues minus expenses. I took those numbers off this section of the adjusted trial balance. And remember, when you're doing your exams, when you use the tutoring revenue on your income statement, mark it off. You're never going to use it again. When you put the expenses on the income statement, mark them off. You never use them again. None of these accounts are used more than once on a financial statement. They only appear once. So we're going to go ahead and put these on the income statement, check them off, they've been used, they come up with our net income. Now, as you know, this net income carries over to the statement of shareholders' equity or the statement of retained earnings. So in the case of Roadrunner's Roost, the statement of retained earnings is only for the month ended July 31st, 2015. Beginning on August 1st of 2015, this ending balance would carry up to be the beginning balance of August 1st. Now, Roadrunner's Roost started on July 1st. It had no balance, so it was zero. We know that we had made 1,136, and we did not pay any dividends for Roadrunner's Roost. The company did not. So its ending balance of retained earnings was equal to the money we had made in July. So again, August 1st, August 1st, this number will carry up and be the beginning balance for August 1st. So after we have finished the statement of retained earnings, and we can look that we have actually had zero balance and we paid no dividends, but we can go ahead and mark the fact that this was in fact the case. Those had no balance, they've been used up. Now we're going to go to the balance sheet, and here is a properly prepared balance sheet. You can look in your book for how to properly prepare a balance sheet. And what we're looking at in Chapter 4 that is different from what you've seen before is a classified balance sheet. And what do we mean by that? We are going to separate current assets from plant assets, longer-lived assets. We're going to separate current liabilities from long-term liabilities. And this will allow us to know how fast we can convert assets to cash, how much of our assets are in long-lived assets, and so we call this the classified balance sheet. Now, unlike the income statement and the statement of shared retained earnings or shareholders' equity, this sheet is prepared at a specific day and time. It is on a specific day. It is only on this day is this a reflection of the assets and liabilities in our company. We are not stating on August 31st that this will look the same. It will not. Things will have happened. Cash will have gone out. Supplies may have been used. We may have taken on more debt. This is only true of this day and time, and we want to make sure it is stated that it is on a specific day and time. So you need to be looking at this in your book and really understanding how a properly prepared balance sheet is made. And this balance sheet was created out of our adjusted trial balance. We took the assets and the liabilities, rolled over that retained earnings from the statement of retained earnings, added in the stock, common stock, and that gave us our classified balance sheet. I do want to make note, now here is how that when I said that the computer is the asset and the contra asset is subtracted from the computer to give you the book or carrying value, there is the book or carrying value of the computer. Here is the book or carrying value of the furniture. And this tells investors we have computers that were worth $5,000. We estimate they've worn out or we've used them up by 139. They have a current estimated value of $4,861. That tells the whole story of that asset. The same thing could be true of the furniture. $8,000 purchase, historical cost, less depreciation that has accumulated, book or carrying value $7,875. So that gives a good story. So that is the preparation of the three financial statements. You take the adjusted trial balance. You use each account only once to prepare your financial statements. If you're doing a test, just mark them off. Don't be using them multiple times. It is quite easy. And now, in the last video of this chapter 1 through 4, the accounting cycle, we will be looking at closing our books. Some of the accounts are temporary. Those are the ones that are for the month ended, the revenue and expenses, the accounts on the retained earnings. All of those are considered temporary accounts. The balance sheet are considered permanent accounts and they will go on from period to period.